Good morning, and thank you very much, Lloyd, for joining us here on CNBC.
Oh, good morning, Wolf. Great to be here.
Now, I have to just ask very quickly, has this been scheduled in order to clash with the start of James Gorman's Morgan Stanley earnings conference call, which kicks off right at this moment as well?
Is he having a call?
Yeah, he is indeed, but I'm hoping lots of people are tuned in.
We should merge those feeds. We should alternate.
Well, we could do that,
yes.
But I think this is going to be more blockbuster, Lloyd. So let's get to the topic of why we're here. We're here for the USChina Business Summit, which you're co-hosting with China Investment Corporation.
Yes.
The last sort of round of this type of meeting was in China in November last year, where, very positive, you announced with them a $5 billion fund to invest in US manufacturing. Since then, the tone of relations between China and the US has deteriorated quite significantly. Is that recoverable?
Oh, no. Not only is it recoverable, it has to recover. We're the two biggest economies in the world. There's no path forward if we disagree or disagreeable with each other over the long term. We need to work things out. And I understand what's trying to be accomplished here. We're not trying to end trade with China. We're trying to even it out. There are different perspectives at work here. I'll just say, I went over in that November. I was part of that trade mission that Secretary of Commerce Ross led. It led to a number of signed agreements, including a co-investment between our clients and CIC, which is the Sovereign Wealth Fund of China, to invest in U.S. industries, that is U.S. manufacturing companies, with a view to increasing their manufacturing to have them specifically export more into China, with our Chinese partners helping them get access to the Chinese markets.
Is it possible that the plug could be pulled on that initiative, given the raised tensions that we've had in the past couple of months?
I wouldn't say at this point anything's impossible, but Secretary Ross, the Commerce Secretary, was a keynote speaker at the event that we had last night that was co-hosted by our partners, in which we had dozens and dozens of U.S. CEOs and the same number of Chinese CEOs working and engaging with each other. And of course, what we're doing here can only tighten that deficit, because here it's Chinese investment in American companies, American jobs, to manufacture American goods to ship to China and sell into China. So this is good all around.
And so you're sounding pretty relaxed, Lloyd, if I may say, about the issue, because clearly trade tensions have weighed on markets significantly, but it sounds like you don't think they're that severe. So overall, do you support the president's attempts to renegotiate these terms of trade with China?
You know, I quite understand that at the end of the day, everybody evolves and changes. China is a developing market that has developed in part. They had an economy based on export at all costs. Even when I say at all costs, I mean even subordinating the interests, health issues with respect to the environment. When you have to grow at 10% because you have to accommodate a population moving from villages to cities and wanting to avoid social unrest and political unrest, you manufacture, produce, export. And to some extent, that is, of course, good for China, and by the way, good for the world that they achieve that kind of stability. But at the same time, some markets around the world, including markets in the United States, got hollowed out a bit. And some political stability that was won for China by virtue of its trading practices resulted, you might say, in some political instability and economic instability in the United States. And I think from the U.S. point of view, it's time to say, let's re-examine where we stand. And so I think the kind of pressure that's being put to bear, is fine. I think it's going to work out, not because I'm so Pollyannish. I think it's going to work out because it has to work out. Usually things that have to happen, happen. And we have to have the right balance.
Let's touch on your earnings yesterday, Lloyd, which was a beat pretty much on every line in terms of revenue, and the overall EPS a big beat. Let's talk first of all about the bounce back in trading. There was a lot of focus on trading last year. Back this quarter, can that last for the rest of the year, or is it a one-quarter bounce back, as it were?
If you asked it the opposite way and said this surely will last forever, I'd also discount that. We don't know. We're in the. I say this. We're more in the contingency planning business than the forecasting business. But the conditions that prevail were not top decile or top quartile conditions in the world. So yes, they're highly replicable. And I would say kind of feels almost standard-ish. What didn't feel standard were the conditions over the last couple of years. People will debate back and forth what's normal, what's the new normal, but conditions where interest rates are zero, yield curves are flat, there's no risk premium, where central banks all around the world are buying all the risky assets, which then therefore put a damper on volatility and the opportunities to perform, that's not a natural state. We have not reversed all of that, but we're walking that back and walking too. So at the first indications of a withdrawal from what, again, is an unnatural state, guess what? The market becomes a bit more volatility. People get paid, compensated for the risk that they're taking. Our clients are doing better, and consequently, we're doing better with them. So I wouldn't say we're popping champagne corks, but we can certainly see what happens when we start to walk back towards a normal financial market.
Now, the share price traded down, particularly on the news that there'll be no buyback this quarter. Did investors misunderstand that? Is that, in fact, a positive because you've got other uses of capital for growth?
I think look, you never know. On the day that earnings come out, there's some, the market rallied into the earnings. There are adjustments that get to be made. Investors, most institutional investors, on the day of earnings, they go and call for meetings, and then they discuss. It's very hard to figure out from one day, from one day. In fact, almost every time there's an earnings announcement, our stock drops. Also, people know that employees can sell for the first time once earnings are released, so everybody expects a wave of internal selling. There's a lot of reasons for stocks to go down, including the fact that we announced that for this one quarter, we're suspending buybacks, and we're suspending buybacks for reasons that are quite good. One of the criticisms and unavoidable facts of the last few years is that the opportunity set was fairly low in our industry. And so the right thing to do, but we were still earning a pretty good return and earning money.
Yeah.
So we were giving money back to our shareholders so they could invest in places. We see opportunities to invest in our own businesses now, and so guess what? We are. And so for this quarter, we're playing a little bit of a catch-up. We had a kind of an accounting effect from the change in tax law that reduced our capital. And so for this one quarter, rather than eke out a return of capital and spread it over a few quarters, we decide we take that medicine this quarter, get additional capital, and invest in our businesses.
I want to touch on succession planning.
Where are you going?
Very well said. Nowhere, I hope, but you have to ask the bosses about that. You and I were just chatting with David. You, of course, made him, you and the board made him sole president and COO recently. Does that mean he is definitively the next CEO of Goldman Sachs?
No, nothing is definitive. It shows my expectation that he'd be the person. He's the fourth COO I've had. So, but I tell you,
he's just next door. I hope but he's terrific.
But he's terrific. I'm kidding, except that's factually true.
Yeah.
But my expectation is, look, we had a bit of a process. We have terrific people. Whatever else people could say about Goldman from time to time, nobody doesn't think we have great people, including very senior people, some of whom stick with the firm, and mostly there comes a point at which your career tapers off and people go outside where they do fantastic things. David is the guy who's left, and I haven't announced anything about my own timing, but I've been doing this job for quite a while, so it's not crazy that people speculate about this.
What's the biggest factor on timing? Is it that you need to see more from David, or is it that you personally have more that you still want to do yourself?
I haven't. I think there's a kind of, not a question of seeing more, but I think that there's an acculturation and a period where you get used to. Look, to talk about David, who I like very much and I've worked with for a couple of decades, his experience and background, his job up to the point when he was COO for a year, never really surveyed the entire firm, and so he ran investment banking and then became COO. There's a lot of complexity to our sales and trading businesses, our investing businesses, our activities overseas. So I think it's good for him to be the kind of CEO in waiting, if you will, have the benefits of being able to survey that and have a period of time where he doesn't quite have the accountability for the consequences.
Lloyd, we have a question from the studio from Joe.
Hey, Joe, how are you?
Lloyd, you're still really sharp. You are still, you don't, I mean, that was good. I've had four, we've had three, Becky and I have had three co-anchors on Squawk, including Andrew, I think, too. And, I mean, who knows, right? I mean, but you're still, you can tell, you're still quick. Can I ask you a question, going back to Davos, Lloyd? Remember how you were in a great mood about business conditions back then, and I guess it had something to do with just business sentiment, really, and maybe the upcoming tax reform, deregulation, and now your earnings it reminded me of the Goldman that in the past, where the estimate would be $3 and you'd earn $6 or something. That happened a lot. Can this and Wolf referenced it. Is there any reason why 2019 or 2020 absolutely has to be well below 2018? Because I see the CBO says that. Everybody has the idea that this is all front-end loaded because of taxes.
No, Joe. Everybody's nervous. And, bull markets climb a wall of worry. The bull market's gone on too long. But, we can have dueling cliches here, but bull markets don't die of old age, et cetera, et cetera. I would say that generally things don't go in the same direction for a long time because people over-adjust to them. Expectations change. If money is too easy, then people put them in foolish places, and then they get, and that's how bubbles form and they burst. And of course, you don't see it till hindsight, et cetera. So there's generally an expectation that there'll be cycles to things, and I share that expectation. But if you divorced yourself from a general feeling of anxiety and just looked at the facts and the numbers and what you can measure, you'd say things look awfully good, and it feels like awfully good in a way in which there could be a bit of a runway here for things to remain pretty good. Inflation is in check. Interest rates, therefore, are lower than you'd expect at this part of the cycle. People are working. Commodity prices are in check, and the biggest commodity price is held a bit in check by the potential supply of more oil coming online if the price rose enough to justify investment in that sphere. Countries that were half a cycle behind us are kind of catching up, and they'll add wealth creation into the world. There's a lot of reasons for optimism, but then again, you have to remind yourself you don't hear the one that gets you, and only in hindsight are the problems obvious. And so I think we will go forward here on a playbook that involves optimism with a kind of healthy state of anxiety that Goldman Sachs has been producing in its leaders for 149 years now.
Hey, Lloyd, let's talk about some of the things that could throw us off, though. I know you said a little bit ago that when it comes to the U.S. and China trade tensions, that you're optimistic about this. But you also said that you're in the contingency planning business. And I just wonder what contingencies you're planning for if things don't get resolved, if we do wind up in some sort of a broader trade war.
Look, if we find ourselves in a broader trade war, things won't happen. Buyers of companies around the world include Americans buying Chinese, taking advantage of Chinese opportunities, Chinese buying assets in America. That's on the investment side. We are huge markets for each other. Obviously, we're a bigger market for them, but we have aspirations to change that. And by the way, the Chinese have aspirations to help us change that. That's why we're developing this cooperation fund. And I think, my observation of the Chinese, and I can't speak for them or the leadership, but they're kind of a consensus-driven, different political system, but also consensus-driven. I think the leadership has been expressing that they want to open their markets, that they want to, deal with some of the problems that the Trump administration and business leaders generally have identified about doing business in China. And they made good pronouncements, but I'm sure when they get back and try to develop a consensus around it, some of the business interests in China get a little bit parochial, and and sort of between intentions and effect, they haven't been accomplished. I think with the pressure that the administration is putting on, it's not entirely a bad thing. We get to the right thing. Again, my optimism is premised on the idea that a real aggressive, mean-spirited trade war is so bad, and the necessity and the advantages that come from trade back and forth is so good, it'd be a very far-fetched thing to not get there when we kind of agree mostly on the facts. It's just a question of Chinese will say this takes longer. We're a developing country. We have to wait. It takes time. We say, guess what? There's been a lot of time. You have developed. Your economy is virtually the size of our economy by some measures. A new day has dawned. Let's get with it. This is what we're talking about. And I think if that's what it's all about, we should get to the right place.
Lloyd,
also, we need each other on a lot of other things as well. Look at the security situation in the world with North Korea. There are other things at stake here, maybe bigger things at stake that provide another impetus for us getting together and working these issues out.
Sure, Lloyd. Getting back a little bit to your business, you addressed the core business in the last few months feeling a little more normal, perhaps to you, playing to Goldman Sachs' strength in the core franchises. I wonder, though, in terms of the broader business mix of the firm now, we hear a lot about some of the newer initiatives like consumer lending, like Marcus. I know you made an acquisition recently of a personal finance app. What's Goldman Sachs' edge in these areas? Where do you see it going in terms of its role in the firm long term?
Sure. I'm super excited about that space for us. And I think people misinterpret this to some extent. So let me say, we haven't just moved, we haven't lost our minds moving to a consumer business that we weren't in historically. The consumer business has moved to us. Because, I mean, consumer business is one thing. If you're lending, if it's a wonderful life and you're Jimmy Stewart and you're lending to 500 people, and you're looking into people's soul and character, decide whether to make an investment, a lending decision, that's one thing. But if you're lending to 50 million people, it's math, it's algorithms. When you slap down a credit card, the credit card company, the bank behind it, is making a credit decision to extend credit to you. Really? In that split second, how are they doing that? They're doing it by algorithms, sophisticated risk management methodology, and it's distributed electronically, and in the case of consumer lending, in our case, digitally. Well, we're very good at algorithmic trading. We're very good at risk management. We're very good at digital distribution. Obviously, a consumer experience is very important here, and we had to import that. It's important, but it's not the biggest part of the enterprise at this point. This has moved into our wheelhouse, and we're taking advantage of it now. Now, why us? Because on the one hand, we have these experiences in digital. A lot of the wholesale platforms that drive the wholesale market were created by Goldman Sachs and then hived off and distributed to a broader community. We also have a balance sheet. Unlike the normal disruptors of markets in Silicon Valley, we're a licensed bank holding company. We could take deposits and lend them out. The other bank holding companies, namely our competitors who've been in the consumer business for a long time, are a bit of a victim because of their legacy businesses. They have big credit card balances and are charging anywhere between 16 and 22% for those. They're not really dying to refinance those credit card balances with consumer loans at 1,000 basis points lower cost or 800 basis points lower cost. We're in a kind of a unique position here. Big balance sheet bank, skill at digital distribution, no legacy businesses that conflict with our creating a consumer business for 2018.
Hey, Lloyd, we were in Washington yesterday. We had a lot of people on from both sides of the aisle. We had Steny Hoyer on, a couple other Democrats who said if they retake the House, they're definitely going to repeal the Tax Reform Act, and I don't know what they'll do with financial regulation. At this point, would you prefer that the GOP holds on to the House and Senate, or would you prefer that the Democrats retake the House?
I live this bifurcated life where I'm Goldman Sachs and I'm Lloyd. I know. On this.
I just wanted to see how you answer this, because how about for Goldman Sachs? For Goldman Sachs, which would you prefer?
I'm for this non-existent party that's a fraction of each one. I'm for the moderates. I want stability. I would like to think
such a simple question.
That whatever
GOP or Democrats retaking the House, which do you want? It's binary. You want the GOP to keep it.
I don't have to answer you because you answer. It's a question that, of course, on your side, the question's simple. But at the end of the day, you're asking me now, or your predicate of your question is the Democrats going to reverse a consequential piece of legislation that will have been in effect for less than 2 years.
They said
Who
that.
wants to live that way? I want legislation to have incorporated the moderates of both houses so they could sustain themselves for more than one
You
Congress.
knew I'd ask you
Lloyd,
something
you just
like
mentioned-
that. You knew it. You know. I know you. You know me. And I love sort of just because you really.
I know you know me.
Lloyd, I want to jump in because we are getting to know you a little bit better because you went on to Twitter recently. And a lot of your colleagues I've spoken to have suggested that was because you wanted to sort of shrug off the image that a Goldman Sachs, a Wall Street CEO might have and put across a more witty, natural side. Is that true?
To be honest with you, I've been CEO for 12 years. I've been trying to get the image of a normal Wall Street CEO.
But the tweeting, is that to offset some of that and put out that there's a bit more of a light-hearted side to things? Is that a fair explanation for it?
I would say that it was not that calculating. What I did was I discovered the instrument. I mean, I like it, and I have to say, one of several things I learned from, in a way from, Trump has done it. I'm not competing with that, but what I observed is, look, you're in the press, you have your responsibilities, I have mine. The day before a story is going to run, I'll get a call from somebody, or our press department we're going to say blip, 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 and we'll say, gee, that's wrong, that's not right, that's a wrong impression, will you please change it this way? And they'll go, no. And I'll go, oh my goodness, what do we do? Now everybody has access. There's been a bit of a disintermediation. And so one of the papers wrote something which was incorrect at the time, that we were about to declare what we were doing was we're declaring that David Solomon would be the sole COO, but instead the story got conflated with everybody's expectations of my own tenure. Guess what? I went on Twitter and I addressed something, and I don't have.
Referencing Huckleberry Finn.
I said, now I know how Huckleberry Finn felt listening to his own eulogy. It got a laugh, but at the same time, I have 90,000 followers, not 90 million followers. But I look down the list, and 10,000 of them are press people who then write the story and pass it on. And so it's not that calculating. It also reflects a personality. I like the fact that it's short. I think it's a challenge to say what you want to say, be a little bit provocative, not too provocative, and say that in a small space. So I kind of like the medium.
Lloyd, it's been a pleasure having you with us, as always. Thank you very much for your time. We better let you get back to this very important conference. Thank you very much.
Well, thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.